Hello and welcome to the weekly market updates from ICM.com. We are going to start by, as usual, by the coronavirus updates, then highlight the key economic events and releases for the coming week, and then go over some of the major charts on the MetaTrader 4 platform. So first, let's start with the coronavirus developments. It's still rapidly spreading rapidly, especially in the United States, Brazil, and India. The total confirmed cases crossed 14.5 million, up around 1.5 million from last week. The recovered cases rose by 1 million to 8.1 million, while deaths surpassed 600,000. The World Health Organization posted a record single-day increase in global cases for the second day in a row, around 260,000 cases. The US also logged more than 70,000 cases a day during the past couple of days, and also publishing 9 single-day record-breaking confirmed cases in the past month. And Australia is dealing also with the second wave, which is picking up in Melbourne. Market participants are continuing to follow up closely on the developments of the coronavirus, especially as governments are still shy from taking serious measures that would hurt the economy again. So they are still stuck between this thin line. It's either they stop the economy again to stop the spread, or they just go for another lockdown to stop the spread. And they have to deal with the consequences on the economy, or they can just try to minimize the spreads as much as they can and continue the business running as usual. So this is the thin line that governments are still staying on. In terms of some positivity around reaching a vaccine. A while ago, AstraZeneca and Oxford, there were some reports showing that the vaccine by AstraZeneca and Oxford was a little bit positive and showed a good response by the immune system to the virus, which is promising. And this is also this could lead to something really optimistic to investors on the long run. So and put an end to the coronavirus. So this is one of the headlines that you have to watch out its effects on the market. So market participants, what I was trying to say is the market participants are monitoring the negotiations either in the Eurozone or also in the United States for the next round of stimulus. In the United States, the Congress is currently negotiating the next round of fiscal stimulus, and as usual, each of the Republicans and Democrats has his own agenda. So still, it's very early to talk about the details or the outcome or the specs of the coming fiscal stimulus. Also in Europe, the leaders started a summit on Friday, and they extended the summit. Currently, a while ago, they started again negotiations. There is some positive progress regarding reaching a recovery fund that should be around 750 billion euros. There are some numbers currently that the hardliners agreed on having 390 billion as grants and 360 billion as loans. This could be one of the main struggles to have been accomplished. So maybe this could have some positivity on the markets. We have to monitor. The euro has been rising on the back of this progress of reaching a recovery fund for coronavirus. So this is from what we need to know about the coronavirus developments and the coronavirus updates on both the things that are related to the economy and also things related to solely to health. Now let's move to the economic calendar and highlight the top events for the week. It's a bit shy in terms of data releases. Tomorrow we start from Australia with the minutes of the last monetary policy meeting. But what could be more important and show significant impact on the market is the speech of the Reserve Bank of Australia governor. He will be delivering a speech titled COVID-19, the Labour Market and Public Sector Balance Sheet. Any comments about the latest breakout and how the Reserve Bank of Australia could respond to any damage to economic activity could affect the market? Authorities are going for a lockdown, and this lockdown could hurt the economy, especially that Melbourne makes around 20% of Australia's population. So this could have an impact on the economic recovery that Lowe was happy about a while ago. So we have to monitor closely the comments of the governor regarding the recent breakout and the readiness of the Reserve Bank of Australia to act with any headwinds to the economic recovery. So this is from Australia. Moving to Canada, we have the Canadian retail sales. A jump of 20% is expected. And we end the day with the weekly crude oil stocks from the American Petroleum Institute. On Wednesday, we have the Australian retail sales. Also, the Canadian Consumer Price Index for June, expectations of a rise by 0.4% versus a prior reading of 0.3%, and the crude oil inventories, the crude oil report by the US Energy Information Administration, expectations of a decline for the second week by 2.098 million barrels. Let's not forget that OPEC last week in the technical meeting, OPEC and its allies agreed to reduce output cuts as agreed before. So they're going down the path by decreasing their cuts by 2 million in August. So this also could have some impact on oil for the coming weeks. Moving to Thursday, we start early with from Europe with the GfK German consumer climate. A little bit of an improvement, but still we're in negative territory. So -5 expected for August versus -9.6 in July. The weekly initial jobless claims from the United States, expectation of 1.3 million claims, similar to the prior reading. And the Eurozone consumer confidence, a little bit of improvement, but still way in the negative territory, -12 versus a prior reading of -14.7. And we end the day with the trade balance from New Zealand, month-on-month expectations of a surplus of 450 million. Moving to Friday, we have more releases. First, we start with the retail sales from the United Kingdom for June, expectations of a pickup by 8.5% versus a prior pickup in May by 12%. So this progress is a little bit positive. And then we have the preliminary reading for the manufacturing and services PMI for July from the Eurozone, United Kingdom, and the United States. We have almost 6 figures preliminary reading, purchasing managers index. All of them there are expectations of a continuation of improvement in the activity or a pickup in the activity that saw a huge and sudden drop due to the lockdown caused by the coronavirus. So we're still in the recovery mode. Most of them are expected to come out above 50 level, which is the norm for expansion. And then we have the US new home sales for June, expectations of 700,000, and we end the week with the US Baker Hughes oil rig count, which dropped last week to 180 from 181 previously. So this is all what you have to monitor this week in terms of economic data and releases. Now let's go to the MetaTrader 4 platform to talk about some of the price action of some of the major currency pairs. So let's start with the euro dollar. That's been rising for the past 4 weeks. We saw also last week the highest weekly close since you can see since late January. So this is a positive signal usually for the euro dollar. We're seeing the dollar fading and weakening against the euro, especially that the economic recovery in the eurozone is a bit much better. And also the second wave in the United States is severe. We're still seeing very high numbers in the United States. The spread is going rapidly. So while in Europe the activity is back to normal almost, and the situation is much better than in the United States, this is giving advantage for the euro on the dollar, since there are some talks also that if the breakout will continue to prevail in the United States or will get more severe, this could hurt the economy more on the longer run, while the European economy could be recovering by that time. So this is what you have to take into consideration when trading the euro dollar. If you can see also on the weekly chart today, due to the positivity of the negotiations over the recovery fund, the euro rose to the highest levels almost since early March, trading at a high of 1467. However, we are witnessing some drop again or move lower, erasing all the euro dollar erased almost all the gains earned during the first trading hours of the day. So now let's apply the technical analysis. Let's have some technical indicators. We can still see that the price is still trading above the 100 and 200-day exponential moving average, also above the 20 simple day exponential moving average, which is the middle band of the Bollinger Band, and the price is still close to the upper band. We can see that the bands are wide and the RSI is almost near 70, so this is almost a bullish medium, but still we have to watch out if you are looking for a negative scenario or a bearish scenario on the euro. You have to look out for a drop below 1370. So to have more information, or to have more a solid ground that the bears are more in control than the bulls. So that's what you have to watch out for if you are looking for a negative scenario on the euro. You have to watch out for any break below 1370, which could open the way towards further drop towards 1250 and then 1170. Let's go to the hourly chart. It's going to be more clear. So here you can see we have two tops, we have a higher high, and currently we are trading back near the 100-hour exponential moving average, which held as a support during late last week. The prices bounced from the 100-hour exponential moving average, so any break below it could open the way towards another drop towards the 200-hour exponential moving average. So this area could be a crucial support area for the euro. So between 1360 and 1380 as a crucial area for any bounce back from here towards a further high, or in a scenario of a break below this level, it could trigger further downside towards 1250. So it's much clearer on the hourly chart. This is a good support level to watch out for, which was previously a resistance here for twice, and any break below it could lead towards a drop further towards 1250. So this is on the downside. On the positives, on the positive side, you have to, so let's draw it here. It's much clearer if you're following. So this is the first support, and then here comes the second support, and for resistance. So watch it. It's very important to watch out for the divergence between these two tops and for any break below the support. In terms of resistance, we have to watch out for today's high 1467 and the previous high reached in March around 1520. So this is 1492 at almost 1520, so plus or minus the 15 level. So watch out for resistance near this area if you are trading the euro dollar. And also on a bigger scale, you better watch out for, let me show you something. So if we go for, if you can set the RSI here, we talked, if you were following during our educational webinars back then, while explaining the RSI indicator, you can watch out for a divergence between the RSI and the price. So here we can see we have a higher price. Well, we have a price, and here we have a higher price, but here the RSI is lower. So, but we're very far from any signs of a reversal. So if on the smaller time frames we witness a drop below 1370 and then the move towards the next support that we talked about towards 1250, watch out for a bigger formation for a reversal on the euro dollar. So this is in terms of pure technical if you are looking for a bearish scenario. In terms of or if you're looking for a bullish scenario again, or if you're riding the wave up, you have to watch out for the break above the March high, which could extend the upside rally towards 1570 and then towards the 1840, 1820, 1840 level, which would be the highest level since September 2018. So this is everything you need to know about the euro dollar. Let's move towards the pound. We're witnessing a little bit of a strong rally today for the pound. On the weekly chart, here we can see that the pound recovered from last week's small losses, and currently we're trading near almost the highest levels since mid-June. If we go for the daily chart here, you can see also a significant bullish candle, relative and size is much bigger than the previous candles, and we are trading near the upper zone or the upper side of the consolidation range that we've been trading in for the past 2 weeks. So if we go for the hourly chart, it's going to be more clear. So here we have this consolidation range that we've been trading in for the past couple of for the past 2 weeks almost. So watch out for any break out of this range. What the good levels to watch out for: 126.83, the highest since mid-June, and then after a 128.15, and on the downside Any break below the previous support of 2540, which could also coincide in the future with the rising trend line combining these previous lows. So the area here is very important for the pound bulls. 2540 and 125 125 125.40. It's a very important area, and then after that we have a support zone near 24.30. So these are the key levels for the pound dollar. If you are trading the pound dollar, watch out for a break out of this consolidation zone. The first level to watch out for, if we broke it to the upside, is 26.90, the previous resistance in mid-June, and then after 28.15. And if we were able to break it to the downside, watch out for any drop towards 24.30. Let's apply some of the technical indicators. You can see that the bands are wide. The market was moving higher from 25 to 26.40 almost, and we're having a similar, a little bit of a pause in the market here for the past 3 hours, but still we're trading near the upper band of the Bollinger Band. They are very wide, so maybe we could have either a sideways move and continue a little bit higher, or a sideways move and then a little of a bigger correction towards this move higher. So watch out for this. Also, the RSI is a little bit on in the overbought territory, but still it doesn't mean that that the price can rally higher. So this is what you need to know about the pound dollar. We highlighted already the good levels. In terms of the dollar yen, we're still trading inside this range that we always talk about. There is nothing much happening at this pair. So for the past, almost most of the time, in the past 3-4 months, we've been trading inside this range: 105.90, 106, and 108, 108.20. So we have to, in order to be going in a bigger wave or a bigger rally, either to the upside or to the downside. First, to the upside, we need to clear above 108 level, and on the downside between below 106. Currently, we lack the fundamentals for this trade, since there's nothing much happening. On a risk-off sentiment, investors are rushing towards the Japanese yen, the dollar, and the Swiss franc. And on a risk-on sentiment, they are dumping the Japanese yen and the United States dollar and the Swiss franc. This is why we're not seeing much of a move on this pair, and it's very you can see it here. If you just go for the ATR, the average true range, if you can just add it in front of you, you can see that the range is very small relative to what we had earlier. So this shows that the volatility in the pair is very low relative to the previous or the prior sessions. So this is all about the dollar yen. Moving to the USD CAD, we have a similar formation of a reversal pattern on the USD CAD. So let's have a closer look on the H4 time frame. So here we have this key support zone near 130 135 level. We've been stuck inside this consolidation range since early June, almost around 200 to 200 points move. So 137.14 and 134.90 is almost 225 points range. For any move higher, we need also catalyst. Nothing on the calendar from the Bank of Canada last week. They kept the policy unchanged, the settings unchanged, so they didn't have any like significant impact on the market except a small drop here and then a reversal. This week we have Canadian CPI and retail sales. They could have some impact on the pair, so watch out for any move. On the downside, watch out for a break below 34.90, which could trigger further downside towards almost 133 level, which was previously here. And on the upside, we have a minor resistance near 36.40, which could open the way also towards another move higher towards 37.14, and then towards 38.35. So these are the key levels to watch out for if you are trading the USD against the CAD. Some of the traders last week, or some of the analysts, the technical analysts last week, they saw this as a head and shoulders. So this is the shoulder, the head, and a complex shoulder here. So to simplify it, you have the support zone 34.90. It is very clear that the price reacted while when testing this zone. So watch out for any break below it, and any break above the interim resistance of 36.40 could also have better volatility or apply better volatility on the pair. Let's use the moving averages. So this is why what's telling us that we're trading inside the consolidation zone. The price is near the 100 and 200 H4 exponential moving average. So this is very clear that we are still trading inside the consolidation zone and looking for a breakout. Also, if you can see, the difference between the 100 and 200 exponential moving average is very small, so we aren't seeing much of a move. So the averages are very close to each other, and currently the 100 is moving a little bit away from the 200, and the Bollinger Bands are opening since they were very tight to each other due to low volatility on Friday in the pair. So this is what you need to know about the USD CAD. Moving to the Australian dollar, also similar to what we've been in for since the rally to the upside that we witnessed following the risk on trade back in late May, early June. So the pair has been stuck inside this consolidation range here. Currently, the status of the coronavirus in Australia could weigh a little bit on the currency. So that's why we have to monitor the comments of the governor closely. So in terms of pure technical analysis, we have to wait for any break above 70. The pair was finding tough resistance near 70 here before this spike to the upside, and even this spike wasn't the pair wasn't able to hold the gains earned on this spike, and then it retreated back towards the 70 level. So it's a tough fight between buyers and sellers near 70 level. So watch out for any break above any breakaway from 70 zone towards the 70-60 resistance area, and on the downside any close below the interim support of 69.20 that we mentioned last week. So it's still holding 69.20. A break below it could trigger further downside towards almost the 67.50 area, 68. So this is what the Australian dollar looks like. Very straightforward, nothing much to talk about. If we also set the moving averages and the Bollinger Band, you can see that the bands are very tight, very close to each other. The distance between the upper band and lower band is very minimal relative to the previous sessions. This shows us that the volatility in the pair is very low, and it's looking for catalysts or movers in order to have a significant breakout or rally either to the upside or to the downside. Even if we go for the ATR here for the past 14 days, you can see that it is very low relative to the previous area. So it's almost the lowest since late February, before all this move took place, the drop and the recovery of around 25%. So this is all about the Australian dollar. Moving to the New Zealand dollar, also we have almost similar pattern. Also the ATR is down, but still New Zealand is in better shape. It could be in better shape than Australia, since they were able to control the coronavirus, and currently they are in better situation relative to Australia. So this could trigger some moves in the Australian dollar, New Zealand dollar pair. Technically, we are still trading below the resistance zone, below 65, 66 level. Any break above this level could trigger a further move upside towards 65, 67, 45. And on the bearish scenario, you have to watch out for any break below 64.95, which could trigger further downside towards 63.80. So we're stuck inside this range for the past couple of days. Any break above this level could trigger a rally towards the previous peak reached late in December 2019, and any break below this interim support near 65 level, 64.95, could trigger further downside towards 63.80 level. The price is trading above the 100 and 200 exponential to 200-day exponential moving average. Also, the 100-day exponential moving average is crossing above the 200-day exponential moving average for the first time since almost we had this move back in January 2020. So maybe the pair, on a positive scenario, the pair could rise a little bit and test the upper band of the Bollinger Band near 66.30 on a break of the 66 resistance area. So this is all about the New Zealand dollar. Let's move to gold, which is almost making new highs, the highest since late 2011. So if we start with the weekly chart. it's very clear that the gold is making a series of consecutive weeks to the upside. This is bullish. It's benefiting from the fact that top central banks around the world have ultra loose monetary policy. Also, currently the prospects of another round of fiscal stimulus from the United States is high. Also, the recovery fund from the eurozone. So this is all supporting the almost zero interest rate. Medium is also supporting. So all these factors are playing in favor of gold. So that's why we're witnessing this rally. You can see we are almost near the highest since late 2011. If we go for the daily chart here, we were trading inside the consolidation range for the past 2 weeks, almost near 1818, and from the bottom 1790, and currently we're trading near the upper side of the consolidation zone. So watch out for a break above it, which could trigger further upside towards 1824.26 and 1838. So currently we're almost near the high. This is the consolidation zone that we were trading in. If we want to look for another way to calculate targets, we can use also the Fibonacci extension. So if we go for the 1236 extension, uh, first let's take different waves. So if we're just considering the last move from 1746 towards this high, the 123.6 could be 1835, 1836. And if you are looking for a much bigger wave, and another bigger extension, so we look for 1844, and if we're taking the full move from almost 1670, the 123.6 level could be at 1853. So we have 1836, 1844, and 1853 in terms of extensions. If you are using the Fibonacci extension and you're going for the 1236 level, this is in terms of finding targets to the upside, and in terms of a reversal or maybe a divergence and a move lower, we have to first clear the interim support near 1805, which could trigger further downselling towards 1790. So these are the key levels to watch out for a reversal: 1805, 1790, which could trigger a bigger correction down. Currently, we are still holding. We're still almost holding the trend line. We have this channel that we talked about last week. You can see here we have three almost tops on the upper side of the channel, and also a couple of bottoms on the downside of the channel. So we are still trading inside this channel and it's holding. So as we said, watch out for a break below 1805 for reversals at 1790. And on the upside, the Fibonacci extension showed us a couple of targets: 1836, 1844, and 1853. If you are using, these are the targets if you are using the Fibonacci extensions of these waves here, from 1745 towards the high, from 1700 towards the high, and from 1670 towards the high. If we go for the Fibonacci, the Bollinger Band, we can see that the price is trading above the band, which could signal that we're a little bit on an overbought territory, but still this doesn't mean that the pair couldn't that the gold can't correct a little bit and then have another move higher. So this is just one of the indicators. That's why we almost advise to use a couple of indicators together to have a better insight on the market. The RSI is approaching the 70 level, and the price is trading above the 100 and 200-hour exponential moving average. So almost we have a bullish momentum for gold. Currently, we're trading near 1870, and this is all for gold. Silver rose sharply earlier today. We posted on our Telegram earlier when the price was around 1930 that we had a series of positive weekly closes for the past couple of weeks. The gold silver was rising, and also last week we had the highest weekly close since September 2016. So this is also considered one of the positive signals. And after that, the price rallied towards the highest since also September 2016. Currently, we're trading near 1977 an ounce. So let's use the same technique if to watch out for levels or to target levels if you want to target levels using the Fibonacci extension. So let's go for the first one. The 123.6 is almost around $20, the psychological level, so it's around 1992. And if you're going for the full move from 16 almost, we're still inside near the $20. So watch out for the psychological resistance to $20 per ounce if you're trading silver. And on the way down, if you're looking for a reversal or negative scenario, at least we have to erase today's gains and fall back below 1945, and then move lower towards 1890. This could signal a bigger correction in silver. Else we are tackling the highest levels since September 2016. So this is everything about silver. Back then in 2016 we had these highs, so almost 2011. So this is what we were talking about, plus or minus 20, the psychological level, and another resistance near 20.70, and then 21.10. So these are the key levels if you are trading or you are bullish on silver and you are looking for an exit. So we have the $20 psychological level, 20.70 and 21.10. And in terms of reversals, you have to clear below 1946 and 1890. This is what you need to know about silver. Let's go for the Dow Jones. We have a little bit of a soft week due to the rising coronavirus cases in the United States and its implications on the economic activity. However, the positiveness from the AstraZeneca and Oxford University vaccine was a little bit positive on the market, and we're seeing that the Dow Jones is erasing the previous losses. We had a couple of red days for the Dow Jones, but still, what's very important for bulls is to clear above almost this trend line, is falling trend line. We had almost a fake out here, so we need to clear above at least to close above 26,700 in order to rally further to the upside. So this is the level. Let's draw it. So we need a close above 26,700 almost to rally towards the 27,000 level. And on the downside, we had this this morning star here. So if we break back below this morning star towards the formation towards 26,325, trigger further downside towards 25,859. So these are the levels if you are trading Dow Jones. Resistance near 26,730 and 27,050, and support is seen towards 26,320 and 25,859. This is for Dow Jones. We can go for you can see that the bands are closer to each other since the volatility has been dropping for the past 2 days on the Dow Jones, but still the RSI is in the middle near 50, so either ways could be possible, and there could be momentum for the next move. So watch out for the break from this consolidation range that we've been trading in sideways down. So any break to the upside or the downside could have could be quick. So on the upside, as we said, 26,700 and 27,050, and on the downside, 26,340, and the bottom, which is in between the 100 and 200 H4 exponential moving average near 25,860, 25,900. So this is for Dow Jones. Moving to WTI, also we're still consolidating in a tight range near the highest level since March. So nothing much happening on oil. Also, if we put the ATR, we can see that it's almost the lowest since pre coronavirus outbreak, since almost late February. So we're witnessing a drop in volatility also since early January. So we're seeing a drop in volatility, awaiting some fresh fundamental drivers or some clarity on the future economic activity that could spark any move in oil prices. If we're gonna go talk pure technical, we need to close above or to break above the resistance zone of 41.45, and on the downside we have to trade below the trend line that we just tested today, that's combining the previous lows. So any break below first 40 level or 39.90, and then 38.67 could trigger a bigger correction for the previous move, and maybe we could test the lower bound of this consolidation zone. So this is all about oil. This is all for today's week ahead. We have very good setups on the charts, but we lack like economic releases this week. It's a bit the economic calendar is a bit shy, so watch out for any breaks of these patterns that we talked about. I would just like to remind you that all the information, analysis, news, and opinions mentioned here are just for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument. We're just doing this to support you in having your own assessment and having your own analysis in order to buy or to sell any of the financial instruments that ICM provides. So as I said, I would just like to repeat that all the opinions, analysis, news, and information mentioned in this webinar are only for educational purposes and shouldn't be taken as a signal whether to buy or to sell a certain financial instrument, and ICM doesn't provide any investment advice. Okay, so someone's asking uh, about the Dixie, the dollar index. Maybe the dollar index is almost around 55% of the dollar index basket is euro. So what's on the euro is usually is opposite to the dollar index. Currently, we're seeing a little bit of strength and riskier currencies against the dollar due to the positive sentiment in the market, and especially the progress on the recovery fund. So that's why we're seeing a little bit of a push in the euro, and this was negative for the dollar index in the morning. And currently, in the afternoon, when the euro started moving a little bit south, we witnessed a rise in the dollar index. But this doesn't mean to be the case. What you have to watch out for any updates for the recovery fund, which could spark any appetite for the euro. This could weigh on the dollar index. Okay, so someone is asking about gold, whether it is the right time to buy or to go for correction, to wait for the correction. What I can tell you first, we can't advise whether to buy currently or to wait. So this is not part, since it would be under giving advice. But usually, what traders do is when the market is trending, they would start looking for retracements to join the upcoming trend. But this just depends on the risk appetite. So if they are willing to take much risk or higher risk, maybe they won't wait for this retracement to happen, and they will just join the trend from where the price is. And the other traders who are more conservative would wait for a correction or retracement lower and then join the trend. So this depends on the risk appetite of each trader. Okay, so for gold, there are a couple of bullish factors, and also there are some risks for the current uptrend. So among the bullish factors, we have the ultra loose monetary policy by central banks. So almost central banks have their interest rates near the zero level. Also, they have their asset purchases programs, so they are dumping much money in the market. So this is one of that supports the bullish trend for gold. Also, the low real yields that we talked about, record ETF inflows, and also the increased gold asset allocation, especially for central banks. This is supporting the rally, but the risks come in with sustained deflation shock, which means that if the inflation levels, we can see that the CPI, consumer price index, and producer price index around the world are also dropping post the COVID-19. So investors are brushing towards gold also as inflationary hedge, since we have almost zero interest rate medium. So if there are no risks of inflation, investors won't be looking for this inflationary hedge, which is relatively gold. And on the one of also the key risks for the current uptrend in gold is any turn from the Federal Reserve, or any hawkish turn. So if the Federal Reserve believes that they've done enough in the market and they have to start tapering their asset purchases, and maybe start talking about, it's very early to talk about interest rates, but maybe just to hint that they would taper their asset purchases, this could have a sharp negative impact on gold. So But also what we have to look out for is that the Federal Reserve won't do such action before he ensures, especially after Powell, the Fed's chairman Jerome Powell stated a couple of times that they need to have to make sure that there is sustained recovery in the market, and especially this cannot be reached until having a proper vaccine and seeing the coronavirus cases dropping sharply, the new coronavirus cases dropping sharply, or at least controlling the curve. So this is one of the key risks. If if a vaccine was able to put an end for the current coronavirus outbreak, and this could improve the economic activity around the world. People will be more confident to go out again, so businesses will start to run again. This also would force central banks to tighten their monetary policies, and when central banks tighten their monetary policies, this could be negative for gold. Yeah, you're totally right about this. But currently, during the current situations, uh, there are no significant like inputs that the coronavirus outbreak is in control. You are welcome, sir, anytime. So I believe this is it for today. On Wednesday, we are having a webinar about how to trade price action and how to control your trading psychology. So stay tuned till then, and thank you for joining.